But people don't understand that. So now that tax rates have been flattened or extended, I think this is a great opportunity to say we need to sit down with you and talk to you about whether Roth conversion still makes sense. I think you need to talk about that in anywhere you're doing your media, because that will get people in the door because they want to know whether it still makes sense.
Welcome into Impactful Conversations, stories and lessons for financial advisors. I'm your host, Dave Edgecombe. Joining me, we got Mike Kinnett. He's going to break down the big Trump bill and what it really means for financial advisors and what sort of the opportunities that kind of lie there. Because the more that we've talked about this and the more I've talked about it with other advisors is, what's the big talking point? What's the big talking point? Well, like you just said before we started rolling, about 2/3 of the bill doesn't really impact retirees at all.
Right.
So what's left? What are the things that stand out to you? And before I get into my spiel about opportunities in general, what's the thing that you look at the bill, you kind of parse through it and you say, this is something that caught my eye right off the top?
Well, I think, not necessarily what caught my eye the most right off the top, but I think the most important thing, especially as financial planners, is that we now have certainty of the tax code, right? I mean, because a lot of the stuff that we want to plan around is we want certainty, right? So that we can actually create a plan for our clients. And the fact that they extended out, made permanent the tax cuts, that's a huge win for planning purposes, right? I mean, I think it's a little bit, maybe overblown for how much it's actually going to do for middle America and retirees. But the fact is they made it permanent. And that's huge.
What do you make of it permanent?
Well, I mean, like all things that are permanent, they're never permanent because every time they want to, I mean,
I wanted to make sure that I was reading that correctly.
Yeah. I mean, the state tax has been made permanent and repealed and made permanent, repealed and made, I mean, they've done it a bazillion times now. So same thing. I assume that at some point in the future, they're going to have to raise taxes. There's just no way around it. The amount of debt we're incurring, the fact that this bill does not actually reduce the deficit, by cutting the 1.8 trillion, whatever the final number they think they're going to cut out of it, that might eliminate the increase in the deficit by overspending in any given year, but it's not really cutting the deficit itself. And I mean, we're paying, almost $1 trillion this year in interest alone. It's crazy.
Does the deficit give you alarm at all that you're not chipping away at it and it's adding more debt? It's like $3 trillion in change, which in change in that sense is huge, but still, does that, from a financial advisor's perspective, are you concerned at what the precedent that it's setting in that regard?
As long as interest rates remain fairly low, it's cheap to borrow money. So if what the government is spending is actually useful and helps grow the economy, right? I mean, when they're doing useful things, it's smart. When they're doing stupid things with money, then maybe not so smart. But I have less worry about the overall debt. I know people are worried about it, but as a percentage of our GDP and what it costs us when interest rates are low, it's maintainable.
Obviously, when Social Security gets mentioned in the bill, everyone, that has my attention. But I think when we had our call a couple of days ago, you kind of had a different take on what the significance of the impact on Social Security.
Big dog whistle, right? I mean, everybody was so excited about my Social Security wasn't going to be taxed. I think that's a common misconception even before everybody was saying we're going to make Social Security non-taxable. The fact is around 65 to 70% of Americans don't pay tax on Social Security anyways. So most people don't. Of the people that do pay tax on Social Security, around half of them, around 50% of them, make too much money for this to have any impact on them whatsoever anyways. So Social Security is still going to be taxable for the majority of people that were already paying tax on it. It's not going to be taxable for the majority of people who weren't paying tax on it already, so it's going to remain that way. I mean, at the end of the day, the calculations for whether Social Security is taxable or not is the exact same calculation it's always been. So that never changed. The only thing they did, which is a plus, don't take that, get me wrong, but the only thing they really did was add $6,000 per person for 65 and over. And that's not chump change, but it's not life-changing for retirees.
Yeah, I think that's a great way of phrasing it is, the difference between me winning, $100 and somebody, Warren Buffett winning $100 is tremendous. So
right.
Yes, it'll make an impact, but in the grand scheme, especially when you're working with high net worth clients, that, is not going to move the needle. But I think
and I do want to say,
yeah,
the perception of what a high net worth client is, right? I mean, it's funny because what we deem to be a high net worth client and what the IRS thinks a high net worth client are completely two different things, right? Mm-hmm. I mean, if you're making $100,000 a year, the IRS thinks you're rich, but if you're making $100,000 a year, you don't feel so rich.
Yeah,
so.
yeah. No, I think that's an excellent point. And I think from a financial advisor standpoint about what's going to have a huge impact on their average client is it's not so much what's going to have a huge impact. It's what are your talking point opportunities to either get in front of new people or get in front of existing clients. And it feels like that's the talking point for an advisor is what are your opportunities that stem from this bill? So like Social Security, for example,
Well, I think
starts the conversation.
I think that's a huge conversation starter, right? Because people are still going to want to know how I'm impacted by this, right? Because there was so much financial noise, there was so much media coverage on, tax-free, tax-free, tax-free. Well, the reality is that this is an incredible opportunity for you to sit down with your clients and show them that while the rule didn't change to make it tax-free, you can show them how to make it tax-free. So, what we do with our clients, probably about 2/3 of our clients, 125 to 150,000, that's kind of the sweet spot of income that they make, pretty much zero taxes on it. Now, you don't get there overnight, but you can show your clients that, look, while the government didn't deliver tax-free on your Social Security, working with us and our team, we can show you how to do that.
Something that kind of jumped out to me was, you mentioned the 85% of the people aren't going to be impacted by Social Security, but there is that sort of fringe population, I guess. Is it incumbent upon a financial advisor to kind of go through their book to see who those people are? Is it that obvious? Is it that easy to find that?
So only if they're doing the tax work to begin with, right? So the reality is the bulk of advisors out there really don't pay attention to the tax return, which is unfortunate. I mean, obviously, I'm a big proponent of using tax in your tax planning, and certainly it's become more in vogue over the last couple of years. But yes, the answer is that anybody that's basically over 62, you should be reaching out to them and saying, hey, we need to take a look at your Social Security and see what the new tax law has in store for you, because there may be opportunities. And even if the $6,000 or $12,000 for married, filing joint isn't that substantial, from what does it put you into does it save you a lot of money in taxes? Which the reality is it's not. But the fact is that what it does do is open up that conversation to, look, they couldn't facilitate the tax-freeness, but with a little bit of proper planning over the next 2 or 3 or 4 years, we can get you there. And especially if these folks are under RMD age, I mean, to be able to show them the impact of what RMDs are going to have on their Social Security down the road. I mean, think about that. That provisional income is just a horrible calculation, and RMDs kill them left and right. So yes, they should be looking at their book. They should be calling their clients and talking to them about what are the opportunities, especially if we have a little bit of runway on the RMDs, how to get us to tax-free.
What about in terms of SALT? I know that it seems like that's a New York, California, the big, high, obvious state tax states, but I talked with an advisor from Illinois. Oh, no, that's us too. And then we talked with you. No, that's me too. What's the opportunity there?
I think SALT is an incredible opportunity. And from a couple different perspectives, first and foremost, you're going to have to do some planning with it. And what they basically did was say, there used to be a $10,000 cap, right, for state and local income taxes. For some states where you have to pay a tax to register your car every year, those fees all came under this SALT limitation. Sales tax, if you're buying a new car, there may be reasons. So this whole thing fell under the SALT limitations, and it was capped at $10,000. And obviously the red states, high income states, were a little bit distraught about it. And the compromise they made was they raised it from $10,000 to $40,000. Well, the problem with it is that, for most of us, our clients are in their 60s, probably are going to have that $12,000 exemption added to their standard deduction. So they're already at $44,000. So how do we get over the hump, right? So that's, to me, is where all the planning comes into play. To be able to use donor advised funds to super fund your future contributions, you couple that with, SALT issues. You prepay some of your taxes ahead of time. You couple that with the SALT. Most of our clients don't have mortgages anymore. So there's some things to do there, but between the SALT, the increase of the SALT to 40 grand, and it does phase out, 250,000, you start losing it for a single person, and 500,000, you start losing it as a married filing joint. But I think for us, the most important thing, they kept the SALT workaround for businesses. And that thing is just the cat's meow. And if you're not using the SALT limitation for yourself, the SALT workaround for yourself, and if you're not talking to your business owners about this, shame on you, because somebody else will.
Why? Why is that why is it the cat's meow?
Well, so remember, at that $40,000 range, most of us have, somewhere between $32,000 plus as standard deduction anyways. So if I'm paying $40,000, I'm actually only reducing my tax by maybe 10, right? Mm. But the SALT workaround allows us to make a payment through our entity. So the entity gets to deduct it as an expense. So let's just say your profit is $500,000 and you send $50,000 in for a SALT payment. Well, now your profit's only $450,000. So you just save tax on that $50,000. And the payment that the company makes, they're making it on your behalf. So just like a W-2 has state tax withholding and federal taxes withholding, this is the equivalent of that. So when you file your taxes, the tax for the state has already been paid through the company. We didn't pay federal tax on it. It reduced our state income tax. It's just the cat's meow. I mean, it's fantastic. And again, it's shocking how many CPAs and how many firms aren't taking advantage of this.
Well, I think that's a snapshot right there. Is exactly why it's so important to factor in taxes when it comes to retirement planning, and why having a CPA on the books or having someone in your practice that.
I mean, we just met with somebody the other day. I mean, in 2024, they paid I think it was $284,000 in state taxes, and they paid it out of their checkbook to the state. And they're talking with us, and we said, well, wait a minute, why aren't you using the SALT workaround? And they said, what are you talking about? And I said, well, what the heck is your CPA doing? I mean, you're paying a CPA, right? Oh yeah, we have a whole firm behind us. And so they left us, got on the phone, and the CPA literally said to them, oh, I guess we could do that. I'm like, I mean, think about that. Just that is almost $80,000 in taxes they didn't have to pay because that CPA was either too lazy or too stupid. And that's the problem. That's why tax planning, especially for the advisors, that's why I think tax planning is so important, because you're going to bring things to the table that even their current financial planner is not doing, and their CPA is not doing for them. It's insane.
Yeah. And I think one thing that the tax planning component opens up is working with a high net worth client.
Oh, absolutely.
What about this bill jumps out to you from that standpoint of how it impacts people that are, I mean, I hate to say uber wealthy, but sort of in a different tax bracket than the rest of us?
Well, I mean, for them, the same thing, right? It allows them to have certainty in their own planning. They love the fact that the estate tax, again, permanent, whatever that means.
Yep.
The estate tax was made permanent. They love the fact that they have a workaround now for irrevocable trusts so that we can get step up in basis and still protect the assets. That's a huge thing that wealthy people like. They love the fact that, private placement survived. I mean, because private placement life insurance is always under scrutiny, but it survives. So there's lots of things that the rich folks, that they love about this bill. I think they like the fact that capital gains, I mean, Biden was talking about raising capital gains, and they kept capital gains where it was, made that permanent. The depreciation, they kept that, they increased that to $2.5 million. That's huge for business owners. So there's lots of little gems in there for the wealthy. For us, middle America, not quite as much, but there's still some things to play with.
Does it mean that a financial advisor needs to sort of recalibrate the value of a client that they can work with, that they have the capabilities? Because I heard from another advisor say, like, hey, our sweet spot is this. We're not equipped to handle a client that's worth $20-30 million, like, this whale of a client. But with some of these changes, does an advisor's office need to start to maybe shift or move around to better equip themselves to handle a high net worth client?
Well, I think in our industry, all advisors should have a strong working knowledge of taxes, because you never know when it's going to come in handy, right? You never know when your average client that has $500,000 inherits $20 million. Right? You just never know what's going to happen. And while I understand a $20 million or $30 million or $40 million client can be intimidating, the fact is they put their pants on and take their pants off the same way that you and I do. So at the end of the day, they're still looking for tax advice. And I'm telling you right now, half of them aren't getting it, because half of those guys that have 20, 30, 40 million, they're small business owners. They're mom and pop shops. They're farmers. They're not working with the Goldman Sachs with billion-dollar accounts. That's not who they're dealing with. They're looking to middle America, and they're talking to their local bank. They're talking to their local advisor. And if you can bring to the table, especially for those of you guys that do, podcast and radio shows, I mean, this is an incredible opportunity to talk about something that nobody else is talking to them about. And it's one thing to talk about Roth conversions, right? Everybody does that. I mean, you can't throw a dart and everybody's talking about that. But to be able to bring something beyond that to the table, and the really cool part about it is, especially working with Impact, is that You don't have to know everything. You just have to, you need to be literally a sentence ahead. You just need to know just an inch more than they know. And when you bring it up, if they like it, the answer is always great. As we start to implement the plan, as we start to move forward together, we'll get more into the details. And then, yeah, you need to find somebody who knows the details. But the reality is most advisors get into this comfort zone and they don't want to go out of it because it takes a work, and maybe it takes a little dedication, maybe it takes a little bit of energy, and they're so busy trying to get money in the door, they forget about the opportunities out there.
Well, as we talk about sort of the unconventional, so to speak, unconventional talking points and opportunities for an advisor, you mentioned that you really like the Trump accounts as a potential conversation starter.
These things are huge.
Well, give me the rundown. Why is
I mean, ignoring the egotistical aspect of calling them Trump accounts, we're just taking that off
ignored,
the board.
ignored,
just ignore that part. But the fact is that the federal government, for everybody born 25 to 28, they're going to give them $1,000. That's sick. And if mom and dad can just put $1,000, I mean, the $1,000 by the time they, if they just leave it there, do nothing, by the time they get to be 65, I mean, it's like 50 grand-ish. And it's all at capital gains rates. So they get to 18, everything's capital gains, which is perfect. But mom and dad can put money into this, which is really cool. Grandparents can put money into this, which is really great. Employers can put money into this. I mean, there's such incredible opportunities, but the talking point really is funding for today and funding for the future, but it also opens up the opportunity to have conversations about Roths, because even though this Trump plan is a really good idea for kids, it's not going to pay for school. It's not enough. And as they've cut out education funding, right, they've curtailed student loans, huge cut in student loans. Mom and dad and grandparents are going to have to step up if they're going to help their kids, right? And so between the Trump accounts, which is a great opening conversation that leads into, should we be doing 529s? Should we be doing Roth conversions, or should we be contributing to Roth for the benefit of the kids or grandkids? I think it's a natural conversation starter.
Yeah, and it's, I mean, like we said, unconventional. What's the opportunity from it opens up the conversation for grandparents, right?
Well, that's exactly what it is, because, I mean, for the most part, our clients are the grandparents, right? I mean, that's really what we're talking about.
Not starting a family at 65.
But what it does is grandparents, the reason why parents like myself have kids, we love them when they're small, then they become monsters, then we love them as we get adults. But we look forward to having grandkids because you get to relive all that emotional euphoria, right? I mean, it's just bliss. It's unconditional love. So we all want that from our grandkids, right? And so grandparents, just like our kids are always our kids, our grandkids are even maybe a little bit more special, right? And this is an opportunity for grandparents to step up and have that conversation, because they will help. Obviously if they can, but they will help. But grandparents, to be able to show them, look, here's how we're going to set up the Trump accounts. And quite frankly, how do you set up the Trump accounts? I don't think anybody knows yet. I mean, we've been on the phone with Schwab and Fidelity for 2 weeks, and they have no clue what they're doing with it. But to be able to, let's set up this account. We can start gifting them money every year. I mean, heck, if all the grandparents do is $1,000 a year for that 18 years, and the Trump account requires you basically to use low-cost index funds. So if they just buy the S&P 500, I mean, we're talking $18,000 over 18 years, right? $1,000 a year for 18 years. I mean, it's like $1.5 million when the kid turns 65. I mean, imagine the nest egg, and it's all capital gains. They don't pay tax as it goes, and it's all capital gains when it comes out. It's sick. This is an incredible gift that grandparents can give to their grandkids. I still love the Roth IRA for grandparents to kind of pass on to their grandkids for education purposes or whatever they want to use it for. But this is a great opportunity because grandparents are going to want to know about it.
And what the opportunity that jumps out, the home run thing is, advisors need to start thinking multi-generational and not just meeting with the retiree, but bringing in the family, bringing in those kids and the beneficiaries.
It's insane not to, right? I mean, as an industry, we work so hard to get that client in the door in the first place, right? And for most people, they just, once that client dies, they wash their hands and move on.
Which is such a missed opportunity.
Oh my God,
goodness.
We retain about 60% of our assets because we're in constant contact with the kids. I mean, literally at age 70, we send out a letter. The parents sign it, but we send out a letter to all the kids saying, hey, we're working with mom and dad. Their taxes are timely filed. They have an income plan. Their estate plan is updated. They have a plan for long-term care. Please talk to mom and dad if you have questions. We do it at 70. We do it at 75. We do it at 80. And we do it every year thereafter because we want the kids to know that mom and dad trust us and are involved with us. And that's the best way to retain assets. And it's a heck of a lot cheaper for you as a businessman or a businesswoman than to have to go find that money over again, right? I mean, that's crazy.
What was the Roth opportunity, the IRA withdrawal stuff that you mentioned on our call the other day, that you felt like this bill, there was great opportunities somewhere in there regarding that? Did I make that up?
You might have made that up, or
I almost got away with it too.
I might have just been riffing on something, but I mean, I still think the Roth IRA, I think, is still the greatest thing since sliced bread, and it's great for mom and dad, it's great for the grandparents, and it's great for legacy planning to help the grandkids, not to necessarily pass on generational wealth, but to pass on the ability to go to school, right? Because the 529s have such limitations on them.
Yeah.
UTMA accounts, I mean, at 18, in most states, some states 21, at 18, 21, the UTMA account becomes the kids' money. And, none of us raise our kids to be idiots, but walk into fast food joints. They're there all the time, right? and this way, the Roth allows you to control the money, the conversion stuff. And, one of the things that we're looking at, especially for clients with maybe a little bit less net worth, that extra $12,000 on the Social Security for the exemption, how about an opportunity to do some Roth conversions with it? I mean, even if it's only $12,000, that's 2 or 3 grandkids worth of funding. It's an incredible opportunity, and you should be talking.
I think that was the opportunity that you were alluding to in our pre-call. And then something that I feel like needs to be kind of talked about, where the cuts to Medicaid, and
it's a big thing.
It is, and it ultimately gets into that. How does this impact the long-term care conversation?
Right. Well, and I think that's the big unknown, because they haven't. The problem with bills like this, the problem with all bills is, one, they always have to go back and fix all the stupid things that they did because they don't recognize it because they're in a hurry to pass it. But two, they pass these bills with broad guidelines, but then the agencies have to come up with the rules to say this is what that actually means. Everybody hates the IRS, but the IRS isn't the one who came up with these stupid rules. Those congressmen passed that stupid rule, and the IRS just has to interpret what they want, right? But so I think the devil will be in the details, and I certainly think that anybody who has done any type of conversations with their clients about, will Medicaid plan in the future, I think we need to revisit that in the very, very near future, because if you told your client that we're going to protect your assets and hide your assets if you ever go into a nursing home, that might not be possible going forward. We don't know it yet because the bill is so convoluted in exactly what they're trying to cut.
Are you worried about what's going to become of Medicaid and what that's going
No,
to happen?
I'm less worried about it, and this is the cynic in me. If you think about it, half the stuff that they passed sunsets in 3 years.
Yeah.
I mean, all the really cool stuff, it sunsets in 3 years. That extra $6,000 goes away. Just all the stuff goes away. So I kind of look at it as a midterm, or the end of the 4-year period, that the Republicans will run on it and say, if you don't vote for us, all that good stuff that you love is going to go away, and we'll make it permanent. So, I mean, that's the cynic on me.
Yep.
They'll figure out how to manipulate that instead of doing, politicians never do what's right for us. They just do whatever they need to do to get reelected. So this is a game I think that they're playing. We'll see how it plays out.
Okay. In terms of the long-term care stuff, what's the opportunity with some of these tax changes to then better fund a long-term care vessel?
I think there's a couple things going on. One, people are still nervous about Social Security in general. So as you're bringing them in to talk to them about Social Security and how is it going to be taxed or not taxed for you personally, this is also an opportunity to have that conversation about, look, you insure your car, you insure your house, you insured your life at some point. Do we want to insure Social Security, right? Because there's those annuities out there that will literally pick up the tab if your Social Security's cut. Well, I think that's a great opportunity to have that conversation with people. And that leads right into the same thing, how are we going to take care of long-term care? On average, about a third of us wind up in a nursing home at some point, men for about 2 years, women for about 4 years. Men die first, mostly because we want to, right? But so I think it's a great opportunity because people are nervous about it. They know how expensive it's going to be. Most people don't think about the fact that they're going to get Medicaid, but a lot of advisors use that as a planning tool, and that might be gone. So I think that you should be reaching out to your clients. But the fact is that every single conversation, every time you bring a client on, just for your own protection, you should have a plan in place or a conversation in place where the client has said, yes, they want to buy long-term care insurance, or they want to buy a life insurance policy with a long-term care accelerator on there, or an annuity with a doubler or something for long-term. You need to have that conversation. And when the client says, no, they don't want to do that, you need that client to sign a piece of paper that said, I told you to do it and you chose not to do it. We're a litigious society. The kids are going to be pissed at some point when mom and dad are spending $500,000 each to go to long-term care facilities. So I think that's a great opportunity, and you should be doing it regardless. So it's not just this, but this is a way to reintroduce the conversation during your next review or whatever you're doing.
So some of the feedback we've heard from advisors, just unrelated to the bill, but just how this year for financial advisors kind of unfolded was, boy, it feels like there's kind of there's not a lot of movement. It's a tough year, and now that there is this bill passage and it feels like, okay, is this the first domino? And now clients are going to start to be more, start going, signing on the dotted line, so to speak. Have you guys in your practice experienced that, or do you see anything that felt like the first half of the year was waiting for something to happen and this could be that movement?
So the only waiting for something to happen that we've experienced is really, we work a lot with federal employees. So we had a lot of them coming in when the termination and the buyouts were announced and wanting to wait till September to finalize things, which I kind of understood. Federal employees are inherently kind of cautious and slow moving. But as far as, just overall numbers and production, I think what happens is that most advisors don't realize they're businessmen. And so they don't pay attention to running a business. They just look on, I'm an advisor, and when's my next client coming in? So if you're running a business properly, you have so many funnels, marketing funnels that you're working with, that even when one slows down, another one picks up, right? I worked with guys that, the only thing they do is seminars. Well, that's great until they're not, right? You have the slow months, you have the holidays. I have people that just do radio. Well, radio has the same problems. Political seasons, the radio time dries up. So, sports, if you're in a town with sports, all of a sudden. So I think that the people that are experiencing a little bit of lull, one, aren't working their book correctly. So they're not working on the assets they're already working with, but they're also they don't have the right marketing in place. And, to me, that's one of the great things in my relationship with you guys. I was a lot like them in the beginning, over the last, I don't know how long we've been working together, but last decade or so, plus we've been working together. I went from having, 2 or 3 marketing funnels to, I think now we're running 23 to 24 marketing funnels. And obviously, you can't have 23 funnels when it's you and one other person in the office.
Yeah, you got to have the infrastructure for it.
Right, you have to have the infrastructure. But as you grow, you need to make sure you expand out, not only expanding out your infrastructure, but you're expanding out your marketing systems. And that's one of the things that you guys do so well, is help them figure out the next marketing program to institute.
One thing that you said when we had our pre-call the other day was about your marketing funnels and how you, for this bill specifically, you approached your messaging on Twitter or X different than what you would put out in other places.
Well, absolutely. So I kind of made fun about the ego thing, about Trump's ego. Well, you can't put that on Twitter, right? Yeah. They'll eat you alive, or X, they'll eat you alive. And what I put on LinkedIn, because they're business people, is all business-related stuff, right? So you have to be aware of your market. You can't just apply the same messaging to everybody, because everybody's not looking at the same media, right? So Facebook, we know Facebook people are a little bit older, so you're going to market in have a different message, or maybe a softer message to them. But, LinkedIn, you're just straight to the point. It's a 2-minute, 1-minute vignette talking about, here's a tax issue you need to pay attention to, call me, and that's true across the board. The stuff that we do on X is a little bit more edgy, a little bit more conservative. I mean, I don't get deep into the politics of stuff, because that's always a slippery slope, but we still are a little bit more conservative in our tone and our approach.
Yeah.
And I think you need to think about that across the board.
I want to give you kind of the last word, because we've covered a lot, but I think, you mentioned the U.S. made the vehicle opportunity there.
Right.
So
the tax-free interest, right?
Yeah.
So you can deduct interest, and I know I'm interrupting, but
no, you're good.
That interesting. That's a great conversation starter, right? The fact that you have an above-the-line charity donation it's a great conversation starter. But if you can talk to them about above the line, you should talk to them about itemizing and what we can do there too, because that opens up a whole new world. And if you can get them to commit to making a rather large contribution to a donor advised fund, 30, 40, 50,000 that they can spread out over 10 or 15 years that they use to make charitable donations. If you can get them to do that, then you can get them to do a charitable remainder trust. And when you get them to do a charitable remainder trust, huge tax planning opportunities.
You've covered a lot, obviously. Is there one more thing that you think this is a really sneaky opportunity that I love?
I think at the end of the day, the best opportunity you have is to call all your clients and tell them that, listen, we need to revisit whether Roth conversions make sense for you. And they do, by the way. They do.
Spoiler alert.
Unless tax rates are going to go down, if your client thinks or you think tax rates will go down further, then Roth conversions don't make sense. But people don't understand that. People don't recognize that. So now that tax rates have been flattened or extended, I think this is a great opportunity to say we need to sit down with you and talk to you about whether Roth conversions still make sense. I think you need to talk about that on the radio. I think you need to talk about that in anywhere you're doing your media and your marketing, because that will get people in the door because they want to know whether it still makes sense. I think that's a great lead in to conversations. It's finding new assets. It's providing them new opportunities. It gives you an opportunity to enhance their current position, diversify their tax buckets instead of just Roths, using IULs and stuff like that to help diversify. I think it's a great opportunity. And I think it's a simple thing. You don't have to worry about being too smart by half, right?
In summation, we covered a lot, but I think
fire hose. Yes.
Well, I mean, 2/3 of the bill probably doesn't impact retirees.
Right.
A lot of it's still being figured out. The devil's in the details. But the biggest point that a financial advisor needs to take away from it is there are opportunities, because we rattled off a dozen talking points that even if it's not a great fit for your client or your prospect, it's still a conversation, and
right.
Then all of a sudden you have your in.
That's exactly right.
And I think that's what a financial advisor needs to look at this bill and not try and parse through all 10,000 pages of it.
You kill yourself.
Yeah, it's finding those opportunities and thinking outside the box just a little bit to see, okay, this is a talking point for me. This is how I can make this bill work.
And you
for
only
me.
need 2 or 3 talking points, and that'll cover 100% of your clients.
Mike, thank you so much.
Always a pleasure.
Fire hose indeed, but I think there was a lot of good stuff in here, and we appreciate your time and we appreciate you sharing it with us. So thank you so much to you.
Thank you for having me.
Thank you for watching. Our YouTube channel is a great resource. Like and subscribe, and we'll see you next time.